The first one is, why bother with pension contributions at year end? Well, as an employee, it's really, really important to time this because this is your moment to do it. Where you're obviously on a PAYE salary, you're getting a pay slip, you must time your pension contributions to go in before on the 5th or before the 5th of April in order to claim that tax relief and lower you out of other thresholds. It's really important to understand that really this video is for people who are probably in the 40%, 45% tax threshold. So let me give you an example. Is if you are earning £55,000, let's use that as a figure, per annum, you might think, oh, I want to lower myself down, so I need to make a contribution of around £5,000 into my pension. Just remember that the pension company is going to recover tax relief for you at 20%. Now, this is where it gets a little bit confusing with kind of tax relief, and that brings me on to my second point about how does tax relief work. Is if you put £80 into your pension provider puts in another £20, so the total contribution is £100. So if you're a 40% taxpayer, you can claim another £20 of tax relief through your self-assessment, and it comes as a refund. And it's really important that you put this through as a kind of a reclaim on your self-assessment. There's millions and millions of pounds of unclaimed tax relief that go every single year because people don't put it on the self-assessment. If you're not self-assessed because you're not in that kind of boundary, just write to HMRC. Maybe just pick up the phone and just speak to them about it. They might be able to do it over the phone. They might ask you to formally write to them and tell them which pension scheme you were paying into and things like that. There are templates online, really easy to find them, so no problems at all. So if you are in one of these kind of danger spots for paying tax, for example, from 60,000 to 80,000, where you're repaying child benefit, your effective tax rate is really, really high, potentially over 50%. So paying into a pension is really effective to lower you out of that threshold. And again, if you're 100 to about 125,000, your effective tax rate is 60%. So because you're losing your personal allowance, so actually trying to lower yourself through pension contributions down into a lower tax bracket is really, really sensible. For one of my clients who was just gone over the £100,000 mark, it was also a point where he would lose some free childcare as well. So with losing the free childcare and the 60% effective tax, it almost was not worth earning that money. It was getting close to kind of 100% tax rate, which is a bit of a mind-blowing way of kind of when you start thinking about it. So actually pension contributions were literally a no-brainer for him. So my third point is I want you to go and understand how your tax scheme works. And this is really, really, really important because there are two types of pensions, arrangements we should call them. The first one is what's called a net pay arrangement. And this is where your pension is taken from your gross salary and the full tax relief is applied immediately on that pay slip. That's a big tick, great. That's a brilliant way for it to work. The other way, which is again very, very common, is something called relief at source. And this is where the pension provider reclaim the tax relief and add it to your pension pot. But there's a kicker here. They only add 20% tax relief. Now, if you're a 40% taxpayer, that means it's your responsibility to reclaim that other 20% relief. And again, millions of pounds of this stuff is going unclaimed every single year. So it's really, really important that you understand it. So you might be going, relief at source, net pay, this is all confusing. The two most common providers of pensions, I think, who do this are Nest and People's Pension. They're really big auto-enrolment pension providers. There are a lot of employers using them. And this is where you need to go out and make sure that you are claiming the right tax relief as well. Well, before I move off that, and it's, I think, a slightly kind of related subject, but I haven't separated into a separate part of the video, I suppose, is if your employer offers salary sacrifice and you are earning between kind of maybe those danger boundaries, if you're over the foot into the 40% tax threshold, actually salary sacrifice is a great way of actually naturally lowering you down. You're taking a sacrifice of your pension, of your salary, and your employer is making a larger employer contribution. It's a great way of actually managing tax thresholds as well. So maybe go and investigate that as well. And of course, then you don't need to worry about whether it's a net pay arrangement or relief. It's or salary sacrifice. It's because the employer's making the contribution. It's a tick in the box. It's great for the employer as well, because the employer saves employers' national insurance. My fourth point is about the annual allowance. How much can you pay into a pension? Well, the standard pension allowance is £60,000 per year, or 100% of your relevant earnings. Relevant earnings, if you're employed, you don't really need to worry about it, but it's the total that you receive through your PAYE salary. There are certain things that don't count for what's called relevant earnings, for example, property income and dividends. I'm not even going to get into that whole minefield. I just want you to know 100% of your total salary can go into a pension. So if you're only earning £40,000 a year, that's the maximum that you can put into your pension. And if you're earning if you're on a really large salary and you feel like you could put £60,000 into your pension, then you absolutely can do that as well. It's great as you're coming up into retirement as well to really boost up putting as much money as you can into your pension, because you might be thinking, oh, well, I'm going to retire in 4 years. Well, actually, 4 years down the line, you can take 25% of that out tax-free as a lump sum. So it's a really, really good tactic as well. Remember as well, with your total allowance, say you were coming up to retirement, you think, actually, I want to try and maximise everything I'm putting in. I've done my 60,000. I want to do some more. Well, look at the previous 3 years of allowances. What the rules say is that you can go back 3 years plus the current year. So there's 4 years in total. As I record this video, I'm right at the end of the tax year. Well, we're about 10 days away or so. So it's just important to understand that year is going to, well, the oldest year is going to drop off because we're about to move into the next tax year as well. So just understand your thresholds. If you're trying to maximise pension, use them before they're gone in terms of these unused allowances as well. My fifth point is, about kind of, I suppose, going back about dropping your income, I suppose, if you're in certain tax brackets as well. And, pension contributions are really, really important for kind of doing that. I've mentioned about, child benefit. 60 to 80,000. Let's just focus on this and talk about it a little bit more. You might be in a position, let's say you're at 80,000. If you make a £20,000 pension contribution, then you might be able to get back in. I'm just tapping it into my calculator. And what that means is if we put £20,000 into our calculator and we divide it by 1.25, here's my very smart calculator, it tells us what a cash contribution. So actually we've put £16,000 in to our pension. Great. The pension provider is going to recover £4,000 pension, making it $20,000. And the great news as well is that you've got £4,000 of tax coming back to you on your self-assessment. But hang on a minute, you were having to repay your child benefit. Now, if you're in that situation and you made that contribution, actually you might be getting around, I'm simplifying the numbers, another £2,000, which is actually a huge, huge win. So if actually you've put £16,000 in cash in, HMRC are going to give you kind of £4,000 back in tax relief, plus another £2,000 in child benefit as well. Actually, suddenly, that's really good value for money, isn't it? So do have a think about it. Some of these tax rates are really close to 60%. Again, earning 100 to 125,000, for every £2 that you earn over 100,000, you're going to lose £1 of your personal allowance. That creates this kind of effective, or do you want to call it a marginal tax rate, between that boundary of 100 to 125,000 of 60%. So for every kind of pound that you earn, you're going to pay 60% tax on it, which is kind of a bit mind-blowing, isn't it? So again, putting more into your pension. Again, the same principle applies as that with child benefit, is if we were £20,000 into that kind of at £120,000, actually putting £16,000 in cash, great. It's going to top us back up to that kind of magic number as well. So do kind of make sure that we are thinking about pensions as well. The sixth point I wanted to make is about the pension taper trap. If you are earning over £260,000, so if your adjusted income goes over £260,000, your pension, your total allowance you can pay into a pension starts being reduced. Again, it starts going from £2 for every £2 over that kind of threshold, you lose £1 of your pension allowance. So at £360,000, you are fully tapered, and you can only put £10,000 into your pension. If you're very fortunate to be earning that sort of money, then it is important for you to understand what unused allowances that you've got. At that likely salary, your employer is probably putting more than that, and it could give rise to a tax charge. You must spend a bit of time understanding what that means, and adjusting things. Going back, calculating unused allowances. If you are anywhere near £200,000 of total income, you must go and speak to an accountant. I just can't, emphasize that enough. It is really, really important. You don't want to accidentally trigger a tax charge. And don't forget, money that you've put into your pension is locked away. There are ways and means of getting it back out to pay tax charges, but it is a bit complicated. But please go and talk to an accountant. My colleagues at Orange Umbrella, they'd be able to help you with that as well. The seventh point I just need to make is, regular payments or lump sums. People tend to get to the end of the tax year and think, right, I need to mitigate some tax. I'm putting a lump sum in. You've got to think about pound cost averaging, because the markets can be, obviously they're moving up and down all of the time. It's like a graph, isn't it? Over the long term, they should be rising, great, which is what we want to happen. But if you're putting in lump sums or, at the end of the tax year, you might be unlucky for a few years where you've hit market high points. So immediately the market kind of slumps a bit after you put the contribution in. So when you look at the pension, you're like, oh, it's not done very well. Actually making regular contributions into your private pension can be a much better way, because it smooths out the performance over time. It's keeping everything topped up. It's mitigating the fact that you might forget to make the pension contribution. I've had plenty of clients do that as well. So just make sure that you've done that as well. Anyway, let me just wrap this video up. Let's just have a quick run over, kind of a checklist of things that you need to do. I want you to go out and check how much of your pension allowance that you've used for the tax year. If you've got unused allowances to carry forward, I want you to understand your tax boundaries. Go and have a look. Where is the 40% tax boundary? When do I start repaying child benefit? Am I earning over 100,000? What would it mean? Accountants, people like me are really good at this stuff. It's dead easy for us to work it out for you. So go and find someone that, it doesn't have to be with my organisation, Orange Umbrella, but you can just go and find somebody to work with, basically. Make sure you're reclaiming your higher rate tax relief, and obviously set up regular contributions to benefit from kind of that pound cost averaging as well. But look, pensions are a great way of lowering your tax bill, building your wealth for the future, taking advantage of all the reliefs, everything like that. 5th of April always comes around super quick every single year. So make sure you're taking some action on this point. Anyway, if you found this video useful, make sure that you like, share, and subscribe to the channel, and you'll find my next video that I publish. All right, thanks for watching. Bye.